All right, so stocks finished the week kind of on a down and up and down mode between Facebook earnings and Amazon earnings and ups and downs throughout today. Even it was a little bit of a roller coaster ride, but we expect that, right? We were bearish a couple weeks ago. We expected some ups and downs coming off that low with a couple weeks of up, which we've had. So this is kind of par for the course. We haven't broken any resistance levels. I'm going to show you that. I'm going to show you, kind of what the indicators are telling us in terms of like change in trend, whether or not we're back to being bullish again, whether we've established, have we washed out enough to establish a low? Do we need to wash out enough? Are we in a correction mode or not? So I'm going to break all that down in today's video. I'm also going to take a look at what's really driving the price action this week. Some really significant moves in different markets this week. So we're going to break that down. And then we're going to take a look at our trade idea of a stock that's kind of in this initial stages of a correction mode itself. We're going to talk about how to trade it and in the stage that it's in right now, based off of what the charts are telling us. So let's go ahead and get started. Today is Friday, February the 4th, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast indicator with the S&P 500. As you can see here, we have a dark green shading again, which means the intermediate line has risen back up above the 50th percentile, though it's still below its market sentiment line. It's got the highest market sentiment line out of all these market indicators. But you notice we're still 2.33% below the moving average. So it's not like we've really turned the corner here. And obviously we still have a red line up here, which means we're below a falling moving average. And we are also below Fibonacci resistance. So we haven't turned the corner. We haven't changed the direction. We had an impulse move to the downside, a change in that direction, but we have not had the change in the impulse move back to the upside, getting back above the 78%. So as of right now, Fibonacci resistance is holding on the S&P. When you look at the Russell 2000, it's even worse because we are 5.5%, 5 2/3% below the moving average. We are below the 23% retracement of the decline. Remember, the Russell did not get. See, the S&P 500 had a little brief intermediate run here. It had about as small of a pullback right there as you could possibly have, and then had a new intermediate rally there. So that's what we're seeing right there on the S&P. The Russell didn't have that. See, the Russell, the intermediate line got down here and then stayed down here the whole time. It never did. It popped up here into neutral territory and barely above the 50th percentile, but not into bullish territory, and didn't get a green line. So this is one continuous intermediate drop versus two that we had on the S&P. And so because of that, we're below the 23%. Now, if I were to activate this and just look at the current drop, wherever that's at here, to that, from that high down to this low point, then we are above the 23%, but still below Fibonacci resistance, right? So that's kind of the idea behind. That's kind of the idea behind the Russell. It's still very bearish. Obviously, not dark pink shading because we're rising. We are above market sentiment, but market sentiment is below 20. That's very bearish. We are in a market, so we are in a correction mode. We are in on the Russell. We're in correction. We are not in the correction yet on the S&P, nor are we in a correction yet on the NASDAQ. Though we're getting closer on the NASDAQ with the market sentiment line almost below 40, but intermediate line still below market sentiment, but also still in bearish territory. Remember, the S&P is up above the 50th percentile. And again, the same thing on the NASDAQ. This is the current drop. After a brief run from bearish to bullish territory on the S&P, they did not get above its market sentiment line there. But we are... we hit the 50th percentile, the midway mark this week on Wednesday, but then we pulled back below Fibonacci resistance. We haven't gotten back below the 23% line yet, which is also the 23% line of the big long-term post-COVID rally that we've had, this multi-year post-COVID rally. So that would be a very significant drop. We get back below 14,330, then we are back into bearish mode on the NASDAQ. I don't think we'll be there necessarily. I think by the end of next week we could be there, but I think by the beginning of next week we'll probably come back up and test this week's highs. I think we'll trade inside of these highs there. Let's take a look at the weekly candle for the S&P first. So you can see, we've had a couple good weeks here. In fact, remember we talked about that we would have a couple good weeks after 2 Fridays ago when it broke down, and we said, okay, it's starting the correction mode, but usually we kind of get a little bounce back, just like we did in 2018. So your short-term sentiment did rally out of bearish territory, is not in bullish territory. Your intermediate line now is out of bullish territory for the first time since COVID. You can see fourth quarter 2018 also brought the market sentiment line out of bearish territory. And then you can also see too, if I were to go back again, 15 and 16 is the other area that we compare this to. The intermediate line got into bearish territory there, and then market sentiment line even dipped out of bullish territory. And then your there's 11 and 2010, both times got out of bullish territory and into bearish territory. So we're not in the bearish territory yet, though I think we're on our way there. But you can tell that we are definitely not in bullish territory anymore. Now it's a question of where are these near-term lines going to peak, and I think they're probably going to end up peaking right around here. If you look at the Russell, you can see we did get, we got an oversold cluster last week on the weekly chart, mind you. So we have very bearish short-term sentiment that still is pretty darn bearish. Both lines still in the lower reversal zone, and market sentiment lines falling. And like I said, the intermediate line is not only out of bullish territory, but it's in bearish territory. And not only is it in bearish territory, it's in the lower reversal zone. So that kind of gives you an idea of how, again, we are in correction mode on the NASDAQ, though we're not there on the others. We're just not bullish anymore in the others, right? The NASDAQ's intermediate line, I said we were getting closer on the NASDAQ because its intermediate line is in bearish territory. So not only is it out of bullish, it's in bearish territory now. Short-term sentiment's bouncing, but you don't expect it. We have dark pink shading and a red line on the NASDAQ, and we haven't had that for a while. We had it for COVID. We have it for 2018. We had it for 15 and 16 briefly. We had it for 2011, or there's 2010, there's 2011 briefly. So, and it's pretty brief unless we're in full-on bear market mode. They don't last very, all these other instances are all corrections, so they don't last very long, but you can see that we are there again, right? We are there again on the NASDAQ. So, pretty bearish market forecast charts. Let's take a look at this chart, and you can see, okay, well, we're done with the bearish candles. We don't have a green arrow yet, but at least we're done with the bearish candles. We don't have a rising PPO yet either, and our differential is slightly positive, so it's not a bearish candle. So, it's a pretty decent week. We still have a negative differential on the NASDAQ, so it's a transition candle, but it's not it's not bullish yet. And then we still have a falling PPO too, obviously still below the moving average, still below the 200. Day moving average on the NASDAQ. Your Russell 2000, of course, we got a death cross going, and definitely a negative differential, falling PPO, no green arrow, so we are not flipping the script anytime soon. Though in the short term, we got some positive momentum. Look at the MACD has turned up, so we don't have pink shading on any of these charts. We don't have three green arrows because we're not above the moving average. That would give us a green shading, but we do have two green arrows in all these charts. But you notice that MACD histograms aren't really, moving up anymore. Like, when you have the green bars, they're moving up. When you have the gray bars, it means they're dropping. So they're all dropping. And that's Russell's just a little bit higher, but remember, it's still below its 23% retracement. When you look at the two-line versions of both those charts, your S&P came back down below the 17-day yesterday and below the 8-day. It did bounce back up above the 8-day today. You're still holding the 200-day, and remember, you have that support. So again, you break 435 on the S&P SPY, and you're back into bearish mode. You'd be below the 200, below the point of control, and all these. Remember, we had the 30-day break below the 50, so you'd have to break back above these lines to kind of really flip the script, right? To be bullish again. Looking at IWM, you are below the 8-day moving average, right? Which is easily below 17. Your stochastics are in bearish territory. Your at least the moving average is. The 30-day is below the 50. They're both below the 200. So we're nowhere. I mean, we are in bearish trend. We are in correction mode. All these moving averages are all in a bearish alignment. So they're all falling, and then you've got price, 8-day, 17-day, 30-day, 50-day, 200-day. They're all in the alignment to the downside. Just like when you're bullish, they're all in the alignment and going up to the upside. So that's the IWM. Remember, the Qs are kind of in the middle. So the Qs are kind of it's below its 200-day moving average and point of control. It's also slightly below its 8-day moving average, and all the lines are in alignment there too, except for these two longer intermediate term lines, 30 and 50, are not below the 200-day yet. So we're still kind of working on that death cross. The 8 and 17 are. but they're not on the S&P. They are on the Qs. But again, that's the next stage. Your first stage is to get the price to drop below the 200. The second stage is to get the 8 and the 17 to drop below the 200, and then your third stage is to get the 30 and then the 50 to drop below. Right? If you look at IWM for an example, price drops below the 200-day, and over here you can see price below, but nothing else did. But price dropped below, and then later the 8 and then the 17 dropped below the 200. Then later the 30 did, and then later the 50 did. Right? So that's your successive stages of this decline. And obviously, if I'm in any of these intermediate stages, once the price gets above the 200, and obviously stays there long enough to bring these two short-term lines up with it, then now that you're done, right? You're done with that. But both these instances, you got up above the 17 and here above the 200, and then failed at the next moving average and came back down. So you can see in the Qs, we are in that stage, right? The price and the 817 are down. Now you're just looking for the 30 and the 50. And SPY, we don't even have price below it right now. You did, but it got back up above it, so it kept the 8 and 17 day above it too. So as of right now, you haven't had the 8 and 17 day, that second stage of that reversal, play itself out yet. Let's look at some of these oscillators. Here's the you see we're still above 25 on the negative indicator, still below 20 on the positive. Same thing on IWM, same thing on the Qs. When you look at the weekly, you got the same thing going on the weekly. Above 30, below 20 on the Qs, above 30, below 20 on IWM, and above 30, below 20 on SPY. So we are in bearish mode there too, and ADX is really low, so we really haven't even started the trend yet. At least on SPY. On IWM we have, right? So the ADX is trending. Like again, we are in correction mode. We are below the 23% retracement of that post-COVID rally. We are in correction mode on the Russell. We're not necessarily there yet on these large cap indexes, but you would expect that they would follow suit unless something drastically changes, right? You would expect, like the Qs again has been gradually following suit, and so you'd expect if the Qs are going to get there, then the S&P will probably get there too, until we see something change, which gives us opportunity to kind of trade these, to sell these little rallies. Your S&P is still below its Ichimoku cloud. You have an intermediate. You're not quite back below -5 yet, but you are above 80. So you are close to a very mature bearish trend. You are there on the Qs, and of course IWM you are as well. If you look at the weekly versions for this, we are still in the weekly cloud for IWM, so that's why we're getting some very strong support here at the 38% retracement level. You do have an intermediate trend on this weekly bearish trend going. You're below -2. You're above 65. To kind of give you an idea of the frequency of that happening, you can see that it's not very often. Right here in COVID we did, 2018 we did, not even at the beginning of 18, but the fourth quarter of 18 we did, 15 and 16 we did, 2011 we did briefly, right? We did just barely, got up above 65 down there. So it's not very common. Not very common. Even 2010 we didn't quite get there. It's not very common to get below the cloud and to get these bearish trends, but you can kind of get an idea of just how significant that is. And when you look at like SPY, we're still above the cloud, right? We're still easily above the cloud. In fact, we don't have a bearish trend going at all here. We're just noisy. We just ended the bullish trend. And when you look at the Qs, the same thing. We just barely ended. We're still above the cloud. We haven't started the correction yet. This has just been a strong pullback. We haven't even come close to starting the correction yet. So it kind of gives you an idea of what to expect here. Like, this how bearish we actually are and how bearish we have still yet to be on some of these, because we are that on the Qs. The Qs is in the cloud, right? And you do have an intermediate bearish trend working here. Finally, let's look at the Bollinger Bands for SPY. You can see we hit the upper, that's why we have a ceiling here. We hit this upper, the middle of the bandwidth. We're still in the lower half. IWM, we are also still in the lower half, and QQQ, we are still in the lower half. So we haven't flipped back up to the upper half yet to where we are now in a bullish trend, and especially up to the upper quartile. So as we look at today's intraday range, you can see we still haven't filled in that gap from SPY. You can see today we hit the high point at yesterday's open, or yesterday's high point there. So we didn't get quite a higher high. We did get a lower low, but we did finish up above that on SPY. On the Qs, we also did not fill in at any of yesterday's gap yet. We did come down from the high point yesterday, so kind of like an equal day there. And then IWM, we did fill in yesterday's gap, didn't have as big of a gap, and we did get a lower high. Again, above the highs, but a lower high. And you can see IWM finished below last week's high. The Qs finished above last week's high, so relatively bullish there. And SPY also finished above last week's high too. So relatively bullish from that perspective, but obviously you still got that big gap that's still holding up above us, kind of pushing on us to the down. We can feel it, but it's, as of right now, it's pushing on us to the downside. Let's take a look at today's trading range, or the trading range in volume. Volume was 118 million. You can see it's kind of tapered off, 118 million. The range, again, slightly below average. So it kind of gives you an idea that we're just kind of consolidating this weakness that we've had. These big days, we've been consolidating. We haven't been extending up to a higher ATR yet, and volume has been coming down below the average, slightly below that average there. So when you get into resistance levels with smaller days and smaller ranges and smaller volumes, it's a pretty good chance. You expect support and resistance to hold, especially if, as you head into them, the days and the volumes get smaller, right, and the ranges get smaller. Volatility really dropped off today too. It dropped off back below the 90th percentile. So the 85th percentile did hold for support. You expect it would. It held for support and bounced on that gap, and then so far we are holding there too. So we are in bearish territory for volatility, so bullish for stock prices, but we are not in that lower half. And again, it's support is holding. You're not going to get down, and when you're starting a new regime, because if you look at the VIX right now, we are in a new regime on volatility. We are still up above the 30 and 50-day moving average for the VIX, even if we are below the 17. So we're in this bearish divergence. MACD's bullets moving average below the 17. That's on the daily chart. But when you look at the weekly chart, you see that we have changed, right? We are up above the 8-week. We are the 8 weeks above the 17. The 30's crossing above the 50. Right there, 30's crossing above the 50. They're both close to the 200. So we have changed the regime. We have been below these moving averages for so long, and now we're above them. And so you can see, to kind of give you an idea, we had that back in 2007. See, we got above it. We changed the regime. We got above the 50, never went back below it. Briefly there in 2008, but we stayed above the 200. But when we changed the regime, the stock market eventually peaked right there in October of 07. That was a high for the stock market. But by the time we got to that high point, we were in a different trend on volatility that we had seen previously when we had been so bearish. Right? It appears that we're getting something similar to that right now. Again, there's your fourth quarter 2018. We had a regime change before that. There's 15 and 16. You can see the regime change there. And then 2011, you can see the regime change there. So we got above these 50-day moving averages in all these instances, and we're doing that again right now. So I still think we're in this correction mode. I think we're just starting on the large cap indexes. I think we're most of the way through on the Russell. I think we're probably more than halfway done on the Russell. Still got some more room to go on the others. So eventually there's going to be kind of a rotation from large cap out of right now. Large cap is the safety trade, but it's going to eventually move its way into small cap. I think there's going to be some ups and downs. I think early next week there might be some ups and downs, small short term, before we probably by the end of next week into the following week, we'll start testing those lows that we hit previously a couple weeks ago. We'll start working our way back down in that area. So look for some volatility in the near term line up and down. Maybe even an update Monday, small update Monday, but then by Tuesday and Wednesday of next week, then we'll see whether or not we actually break up and change the narrative and flip the script and now we're bullish, or this is just a sell the rally and we're still in correction mode and we're just going to kind of make the next leg down. Whether we actually get the lower lows or not, or we just hit this past low, but our next leg down. Probably by the end of next week, we'll be started on that. Is my expectation. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that tell you why you should be a lot more bullish than I am, or why you should be a lot more bearish than I am. Post those in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching this on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. Number two, you want us to do another video again Monday. So when you click on that, it gives us feedback that you like our stuff, that you want us to keep doing it. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have about what I brought up? Post that in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things on the page. Click on this Market Outlook Live icon. It takes you to this page. This I've already done today's trade idea that you'll hear at the end of the video. We already did it in this class today. This is where it's done live at 3:30 Eastern time. I also looked at other Market Outlook trades that we've done previously to see whether we should stay in them or get out of them. So we talk about that. That's all done, and this is like a little 10-15 minute video we do Monday, Wednesdays, and Fridays on this page. So check, you can see all the old archives there as well. If you come back over here, you can also get to it by clicking on Market Outlook Live Trade Review in the menu. If you come down here, you can see our upcoming classes. Click on View More. That takes you to your calendar. Here's all of our upcoming classes, as well as all our recordings, including my technical analysis class that was recorded today. You can see that there. You can also get to it by clicking on Trading Rooms there. Come down to the bottom, click on that heart. It opens up this tab. Hit that like button. Click on that thumbs up icon. Opens up this tab. Hit that like button. Again, the more you do that, it helps us get our content out to more of our followers because of the engagements, right? More engagements, more they push it out to more people. That's how Facebook and Twitter work. It benefits you, so that really helps us. That's why we always ask for it. It helps you too because Twitter and Facebook promote content in your timelines from the accounts that you engage with. So if you want to make sure you see our stuff always, then make sure you're always engaging with us. So we try to make it really easy for you to do that right here while you're watching. All right, now let's take a look at what's driving the price action today. And you can see it was a kind of a risk-on day from the beginning. You had commodities rallying. They kind of stayed up the whole day. The equities started the day down, IWM down more than the Qs. By the end of the day, they both rallied. The Qs outpaced commodities. Briefly, the small cap and the S&P were above the commodities too, and they pulled back at the very end of the day. Everything pulled back at the very end of the day going into the weekend. The dollar was down, gold was up, so flipped on that. Emerging markets underperformed. Despite the dollar being down, emerging markets underperformed U.S. equities. Real estate was down, and long-term bonds. Yields really took off. That was your big mover. But let me give you an idea of what it looked like going into this, to this Friday. So here's how the assets did before. Small cap U.S. equities and emerging markets did really well the first 2 days of the week. Emerging markets eventually ended up holding most of their gains. I remember the Qs lost a lot yesterday, and we gained some of that back today, but well off their highs for the week. Commodities stayed up strong. Both those taking advantage, and gold too, taking advantage of a very, very bearish dollar. And yields just took off like a rocket today, or this week. If you take a look, let's go look at the weekly chart for long-term bonds. So let's go here to the week, and you can see we've closed slightly below the 200 week. So here's an indication of where we can either, this is kind of like one of those toe touches below, where you just get a little bit below and then you rally back up, you get a little bit below, you rally back up, a little bit below, you rally back up. So we might be in one of those instances here, or we could also really break down and work our way back down towards, because we're in the value area for the 5 years at least, work our way back down towards that point of control. That's TLT. IEF is the short term of the 7 to 10 year. So this is more with the 10-year yield. You can see it is below its 1 year point of control, and it's a little bit more below the 200 week than the TLT is. Of course, SHY, which is by far more influenced by Fed funds, it's well below, right? So when you go back, however many years for SHY, you can see, the Fed was raising rates from 15, 16 on, and then they ended raising rates in 2000 and 2018, December of 18. So those short-term rates really fell below the, it was in a bear market, right? But then you can see where they've been, there's your rate hikes in '04 to '06. There's your rate hikes here. But you can see that when you are in bearish mode, it can really bounce up. So there's the bear market that we were in there. That was kind of masked by the FANG stocks, but it was a bear market. I mean, shoot, it's about as big of a bear market as what you had in '07, '08, right? There, you just didn't see it because these FANG stocks did so well. And but the problem is, because they were the only ones that did so well, there's a big disparity now because of that. So, but it's really kind of falling hard here as the Fed's raising rates. In fact, when you look at now the Fed rate hike odds for coming up in March, let me see if it stayed there at 35% by the end of the day. You can see we had finished the day at 31%, so there's now 31% chance. We doubled what it was yesterday. We doubled to 31% chance for a rate hike, a second rate hike, so 50 basis points in March. Obviously, if we get to May, you can see now the odds are 99% that we'll get 50 basis points by the May meeting, 99%. So if we're not getting 50 in March, we're going to get 1, 2. So remember, the past precedent had been from the 15 to 18 cycle, rate hike cycle. The precedent was to raise rates in March, June, September, December only. Now, granted, back then you only had the press conferences. Now you have press conferences every meeting. But that was the precedent then. And now the precedent before that, before they started having press conferences, the precedent was every meeting. In '04 and '06, they did one at every meeting. So when you look at here, let me get my calculator up. When you look at, okay, so there's 99% for 2 in 99% for 2 in March. There is a 90. Let's see here, 100 minus 0, so 100 minus. So there's a 99.1% chance for 2, and then there is now a 35% chance for a third in June. So, the market's saying, okay, there's a good, you can see that actually drastically changed. In fact, I'm a little skeptical of that number because you can see that it was actually the opposite. If I were to go back out to December, let's see what December's options look like. What are the odds? Yeah, it looks like you have the same kind of thing here. It looks like the market is saying we're going to get some rate hikes very quickly, but then after that, after this, once you get these two, then it's going to really slow down. You can see you got really high odds for 3 by July, but then through September, you only have really high odds for 2. So it's kind of a little skew-wampus there, but you're definitely, like, between March and May, you definitely have some really, really high odds for 25 to 50 basis points. The market's starting to price it in, and you see that reflected in, the 2-year yield today. When you look at the 2-year yield, up to 1.32%. It was at 1.19, and we jumped up 12 basis points today alone in the 2-year yield, up to 1.36. And when you look at the 10-year yield, that's at 1.916. So we're still at about 60 basis point spread. Over here it's the 63. I don't think this has been updated yet. The Fed says we're at 62 basis point spread with the data that they're providing there. So that's a really big jump, really, really big jump. But that again is a reflection of increasing odds that the Fed's going to raise interest rates. Let's take a look at some of these charts. One of the signs I look for that we've actually hit the correction bottom is that we get a jump in the trend to really extremely high levels. Obviously, we're not at extremely high levels, 0.65. These are hardly a washout low point. The moving average, the 10-day average, so the 2-week average for the trend is still below 1, and it never even did peak above 1. So we haven't really flipped that there yet. When you look at how many stocks are below the 200-day moving average, it usually gets down to these really low levels during these major corrections. There's 2011, 15, 16, 18, fourth quarter of 18, COVID, and you can see we've gotten down to 250, but we haven't really gotten below that. So that doesn't really suggest a watch. And you can see the moving average is still at 338, so still well above these areas. We're not anywhere near that yet. The skew hasn't washed out yet. It's still around 130. If you look at where the skew typically gets when we wash out, on these big correction modes. There is fourth quarter 2018. There's the COVID drop right there. There's 15 and 16 getting down to 120 or lower. And then, of course, 2011, I have to go about 15 years. 2011, over here, we get below 120 as well, 117, 115. We're at 129, so we're still not, necessarily washed out yet. And if you look at how many stocks are above or below the 200-day moving, not this one, sorry, the above the 50-day, this typically washes out too. There's 15 and 16, there's fourth quarter of 18, there's 2020. If I were to go out to see 2011, you see very similar washout there. So we'd easily get below 50%, and we're not there, right? We're not there. We are still well up here at 1.14. So we haven't really hit this correction low point yet. We haven't really, and I've said before, if you think this is a correction that we've had, at least on the S&P and the Nasdaq so far, then that kind of gives you an idea of where you're at on the weak hands index, right? If this has been really painful for you, then you've got pretty weak hands. If you haven't, we've rallied. How much have we rallied off of that COVID low point? You look at the zigzag indicator here, and let's put up a 10% number because we still haven't got that yet on the S&P. It was 9.8 is how far we got down to. So we still haven't got that 10% tag to show up yet. We've rallied 114% off of that. Even if you were to include the COVID, like from the pre-COVID high point, we are still up 32% off the pre-COVID high point. If you come off of the pre-fourth quarter 2018, so when that fake recession started right there, right? This that faux recession I said that ended there in COVID, but it was because the FANG stocks kind of masked that. You saw that with the 2-year the SHY, right? Well, from that point, we are still up 53%, which is a 16% annualized return over multiple years, right? 1, 2, 3 plus years. So, if you feel like we're in correction, then maybe you weren't around for the fourth quarter 2018. Maybe you weren't around for 15 and 16. Those were actual corrective modes, and this definitely has not been. Now again, the Russell's a different story. Like, we did drop 20%. Not that that's number means anything in terms of defining a correction, but we have dropped a lot more on the small cap index. We are in a correction there. We have dropped below that 23%. This is a much bigger deal, but we just are not there yet on the indexes where most people are feeling it, right? Because more people are in those big Teslas and Apples and all those type names that are more associated with QQQ and the S&P 500. Let's take a quick look at the sector rotation. So give me 1 second to pull that up here. We'll take a look at this week. You can see energy's just taken off big time. But if you look at just this week, you can see energy had a great week. So did financials. Discretionary had a really good week after struggling here previously. And you can see communication services, Facebook mainly, really dropped off. Google's actually positive, but wasn't able to help it. Facebook was down. Netflix is in there. Twitter's in there. Other social media companies. So you can see the kind of the sector moves. If you take a look at the 12 grid on this, you see the S&P 500 in top left. We're below the moving average, and everything looks very similar, except for a few things. Financials, dark green shading the green line. Energy, strongly bullish, and then some of these are not as bearish. These safe haven areas down at the bottom. So clearly we are in a correction mode. In fact, when you look at the relative rotation graph for the S&P 500 sectors, and we put it on a year, here, you can see what's moving up to the left. Up to the right, you have utilities and staples and real estate, healthcare, the financials, energy, really killing it up to the right. And then on the other side, there's your communication services, technology, discretionary, all moving in the wrong direction. So the long-term rotation is towards safety, even if the short-term rotation is the opposite. XLK is moving up, XLY is moving up. So your short XLU, P, E, F, I, they're all moving down to the left, and these are slightly to the left, and these are moving up and slightly to the right. So the short-term rotation is bullish. but not that long term. So when you look at like, for an example, XLK here, and we'll put that relative down here to the bottom to VTI, which is the U.S. equities, you can see the relative strength. This is on a weekly chart, had been positive, and now the momentum's negative, and you can see how it's kind of turning around. You're still above its moving average, the 40-week moving average, exponential moving average, but we still haven't changed that yet. Whereas utilities has been negative, it's now above its moving average, and you can see its momentum and relative strength is both rising. This is on a weekly chart. So when you look at on the daily version, we've had some pretty strong momentum, relatively speaking, here. You've had some pretty strong momentum. We've been bullish, and now we're just kind of rolling down right now. And XLK, it's been pretty weak. It's been pretty weak. It's just rolling up right now, but you don't expect that will last very long. And it looks like the momentum is already actually slowing as XLK stays below these moving averages here. All right, let's take a look at our trade idea of the day, and it's actually on Fastenal. Let me pull that up here. Fastenal, you can see, is in a bearish chart. It's got a bearish posture. Market sentiment's dropping. Short-term sentiment was pretty bullish, but has now reversed back to the downside. We're well 7% below the moving average. It is in bearish mode. If you look at its long-term chart here, you can see it's getting bearish candles. We're red arrow, falling PPO, negative differential. When you look at the 3 green arrow chart for Fastenal, you can see we are below the 8-day and the 17-day moving averages. We're back below the 200-day. Again, remember, it's price. This is the first stage, and then the second stage is the 8 and 17. It seems like we're kind of getting into those stages there. When you look at the DMI, it's got the bearish chart back above 25, still below 20 on the positive indicator. When you look at the RSI and the CCI, they never did get very bullish, right? They stayed in bearish territory in the lower half of the chart, back below 40 in the RSI. When you look at the Ichimoku cloud, we are easily below the cloud, back below the green line, well below the blue line. Very strong trend going there on that indicator. When you look at the Bollinger Bands, we are bearish mode here. I've been showing you the Hull indicator here lately. The Hull is telling us we're bearish. And you can see that the flip and the change of direction on the candles here. Almost back below the Hull, the 20-day average. In fact, the actual price is below the 20-day average. So we're not there, but we're close to flipping things around to where we get a red arrow on the Hull, a red line again on the Hull, and then flip the parabolic SARs up all the while being below the 200-day Hull up there at the top. So a very bearish pattern. Again, you saw on, let's see, not on that chart. You saw on this chart that we're actually above the point of control for the last year, and it's not very far away. Now, if we break that, we can be pretty bearish, but there's going to be some pretty decent support there. So what I decided to do was to come over here and sell the bear call spread at 57.5 and buy the 60. We ended up getting, but when we did this trade, see right now you're kind of in the 55-cent range. When we did this trade, we got 65 cents for it during the Market Outlook live session. So we're actually up a little bit so far in the trade. And again, this is one of those bear call spreads that if we can get 50% of maximum gain in the next 22 days before we get to the 20-day window, then we'll take it, right? Free up the capital and try to make another run on another stock with the same capital to get it, instead of waiting in this and getting the other half of the maximum gain for the next 20 days, we'll take it and try to get another full maximum gain on somewhere else before that. So that's kind of how we trade that. So that's our trade idea of the day. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Have a great rest of your weekend, everybody, and we'll see you all next week.